I mentioned, we have come through some tough economic times. Usually insurance is the first to suffer as consumers tighten their belts. How are you seeing the environment at the moment?
It's true we have gone through some challenges over the last 2 years, but we've witnessed some uptick or improvement as the economic situation has continued to improve. So with the improvement in the economic situation, we have seen an improvement in the uptick and interest of insurance, but there's still a long way to go.
What sorts of demand are you seeing at the moment? What do customers want there? Do they want investment products? Do they want risk products? And how are you positioning yourself to sell those to them?
It's something that's probably not unique to Kenya, but we have seen a lot more interest in investment related or linked products. Most of the consumers here would like to see an element of investment embedded in their insurance products. So that has continued to be the case. So pure risk insurance products have not taken off in the market here as one would expect, but investment ones have. So in terms of coming up with insurance products, insurance players here have to incorporate an element of investment.
And of course, we have seen a nice pickup in equity prices in Kenya, in fact, trading back at their 2010 highs at this stage. So also something for investors to ponder, that they want to be part of this recovery, don't they?
Yes, we have seen the improvement. It's been, we're looking at the region of 30 to 40% improvement from the beginning of the year. So it's an area that has continued to improve, but you're right. I think a lot of it has to do with the global improvement in economic parameters, as well as the general optimism that the market here has witnessed in the last few months.
Of course, how are you playing that? Because at the same time, you must be doing quite well with shareholder funds that are invested in the markets at this stage. But at the same time, you also have to have a focus on the underwriting business. How are you balancing that? And how's that going to come through when you next report earnings?
Yeah. Given the upheaval in terms of investment income over the last 2 years, we have focused on improving our underwriting results because, as you can imagine, those are the ones that one can rely on. So even as we've continued to do well in our investment income, and which we have tried to diversify as much as possible so that we are not too dependent on the stock exchange performance, we have had to focus quite keenly on our underwriting profits, which we have done through products, ensuring that the products we are coming up with take well in the market, and that we will continue to see an upsurge in the uptick of our products, because underwriting results are the more sustainable ones as compared to investment returns.
Mm-hmm. So you talk to us about the diversification of your investments. I mean, are we looking also at government paper, at corporate paper as well? How are you diversifying yourself at this stage?
The situation in Kenya is such that interest rates for government paper have come significantly down. We're looking at the region of 2% for 91-day treasury bills. So really that can't be the investment option or the only investment vehicles that investors here are looking at. We, for example, as Pan Africa Life, have had to diversify and look at the property market as well, where we are witnessing higher returns than government paper or corporate bonds for that matter, because corporate paper, as you know, is pegged to the government bonds.
Well, with growing demand for insurance products, what's your persistency ratios looking like at this stage? Are we seeing more Kenyans holding on to those insurance policies?
As the general optimism and improvement in the weather has continued to happen, we've seen persistency improve, because one of the things that happens here is if the economic situation is not doing well, quite a few of our customers are under pressure to continue paying the premiums, and we witness increased lapses during economic hard times. We've obviously tried to incorporate that in making our products a bit flexible in terms of modes of payments and frequency. However, with the general improvement in the economic situation, we have seen an improvement in persistency. But part of the improvement is to do with the products themselves, as opposed to just the improvement in the economic situation.
Tom, just a quick one. The competitive landscape, I know a number of South African insurers are also looking at taking some of their low-entry products into markets like Kenya. We have Liberty on the back of Standard Bank. We also have Metropolitan looking at those markets. How are you seeing the competitive landscape at the moment, or do you think the pie is just simply big enough for everybody to share at this stage?
The insurance penetration in Kenya and the region here is quite low compared to South Africa, for example. So from that point of view, yes, there is enough for everyone. However, you must realize that there are over about 44 insurance companies, Kenyan insurance companies, which are quite a few compared to larger economies like South Africa, where I believe the number of insurance companies is lower than that. As a result, we have seen some of the players resort to price undercutting instead of probably being more innovative to attack the untapped market. However, the coming onto the soil of this region of Liberty Life and other South African big companies is a welcome move to the customers here because one would expect that they will come with ideas of new products, probably new ways of distribution. So it's a wake-up call for local players. But as you know, as Pan-Africa, we are quite ready for them. And as market leaders in life insurance, we are going to give them a hard